Negative oil prices, the latest on the stimulus check, plus the complications of retiring when an age gap exists. We'll talk about all of that here on the program. This is Dollars and Cents. My name is Joel Garris of Nelson Financial Planning. We are Central Florida's longest running radio program. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web, thanks to the folks at FeedSpot, an accolade we earned at the beginning of the year. So welcome to the program. We are, of course, in today's world, still on a Thursday schedule, even though the program airs on Sunday. So we are recording this in our office on Thursday. Mr. Gaffey's back over there in the studio working the board, and so we will be then airing it on, of course, Sunday morning. So that means that there is still a little bit more to go for the week, but even so far in the week, there has certainly been a lot going on this week. Our clients here at Nelson Financial Planning had another investment conference call with a portfolio manager, and so we thought it would be good to kind of share some of that. Of course, as we mentioned at the top of the hour, oil prices went negative on Monday, so got to talk about that one. And then lots of folks are still without their stimulus check. So what can they do to try and get that check? So biggest takeaway on the conference call that we did with our clients and an institutional portfolio manager out of Boston was that we actually had a number of participants, so that was good. Back in the pre-COVID days, we used to have those sessions as dinner meetings with an open bar and all that kind of stuff. And unfortunately, it was sort of BYOB, if you will, to the conference call. But we're looking forward to when we can have those meetings regularly. So hopefully that will be soon enough. But some of the biggest takeaways, when you talk to these professional portfolio managers that really do dig down much deeper in terms of whether a company makes sense to own as part of a mutual fund portfolio, the reality is that they're looking far beyond what the numbers are, far beyond what the information is on the internet, to really look at a company with a much broader perspective than I think most people typically look at a company. And so for them, it really breaks down to sort of the experience of the management team in terms of selecting a particular company, whether to own it or not inside of a portfolio. They're, of course, interested in the experience of the management team, as you would expect with anything, right? I mean, you don't want a doctor to perform surgery on you on his first day out of medical school, nor do you want to invest in a company with folks that haven't really ever managed a company before. So they're looking for folks that have experience in terms of managing companies and certainly seeing crises before, whether it's 2008 or even a little bit further back, 9/11. That's kind of one piece that they look at. The other piece that they look at is, of course, the size and the type of the company. And here we're seeing, particularly in today's world, where it almost seems like being bigger is in fact better. Those companies generally, historically, survive economic downturns better than what you would normally expect to see. And so the bigger is better concept also appears to be working out for folks that are applying for federal government loans these days as well. You hear the stories of how a lot of smaller businesses were sort of shut out of that first round of government loans for the pension, the payroll protection portion of the CARES Act. So those types of loans that have gotten out there, that loan program was in fact increase so that hopefully more small businesses can partake. But basically the concept, bigger is better. And certainly if you look at the market, you're certainly seeing a difference between large company performance and smaller company performance. In some cases, quite a bit of difference in terms of what those numbers are, of course. So the size of the company matters in terms of, looking at different investment opportunities. Also, the type of sector that it's in, right? I mean, there are obviously sectors that have gotten hit much harder than other sectors. And so those types of sectors that have gotten hit, travel and leisure, hotels, airlines, those types of sectors are really kind of struggling, certainly. But there are other sectors where things seem to be continuing to move along pretty well, whether that's technology or healthcare or financial services. Two of the largest technology companies, right, that we all know, Microsoft, Amazon, are actually positive since the beginning of the year in terms of the performance of their stock. So definitely the type of company, the size of company matters, but also the type, meaning the sector that it's in. And then lastly, and I think even more importantly, is the status of the balance sheet. And when you talk about the status of a company's balance sheet from an investment perspective, what you're talking about there is the nature of what it owns versus what it owes, right? A balance sheet consists of assets, which are basically stuff that an individual or a company owns, and a liability, which is basically the loan. So just as it was so important in 2008, the companies that best survived 2008 were the ones that had less on the liability side, less on the loan side. You're almost seeing a repeat of that from an investment perspective, where companies, just like individuals, right? I mean, if you have a bunch of credit card debt, a bunch of mortgage debt, plus a home equity line and all that, you're not in that great of financial shape. Something like this is clearly going to have a much greater impact on you than if, for example, you didn't have all of that debt. Well, the same thing also applies to corporate America, because in corporate America, if you have too much debt and then you run into a problem like this, then you definitely wind up having a much harder time to get through this particular period of time. So some important things, to kind of definitely be thinking about in terms of a portfolio. So that was kind of the interesting comments and takeaway in terms of what the professional mutual fund managers are really kind of looking at in today's climate, and understand the perspective of a good active manager when it comes to a mutual fund. Is their perspective is to look out 3 to 5 years. So it's not a situation where they're looking out 3 to 5 weeks or 3 to 5 months. I mean, they're really trying to look through what the post-COVID world looks like, and to try and make decisions based upon that. 3 to 5 years, that's even longer than an election cycle. So again, those are some interesting stuff, and sort of a good perspective on the kinds of things that the professionals are really sort of dialing into or really looking at in great detail in terms of what they're doing to pick individual companies within a portfolio. So some interesting stuff. Next up, we'll talk about the stimulus check update. For those of you who haven't gotten it, you may be wondering, okay, what's going on there? And hopefully we'll be able to answer those questions in the next segment. So stay tuned for that. This is Dollars and Cents. This is Joel Garris of Nelson Financial Planning News Radio, WFLA, Orlando. Welcome back to the program, ladies and gentlemen. Now, you may be wondering where your stimulus check is. Certainly they sent out the first batch of checks, and you may be getting jealous of your neighbors and friends who got their stimulus check, and you're wondering, well, wait a minute, where's mine? When am I going to get it? And what can I possibly do to speed it up? Well, if you recall last week on the program, we actually kind of walked through on the irs.gov website. That's the website that you want to go to for the exercise we're going to talk about in this segment of the program. So that website is the one that will help you hopefully speed up the distribution of your check. here's the rub in that first batch of people, and this is something that sort of came out this week with some additional guidance that the IRS issued, and that is the folks that got that check in that first batch were the folks that had bank account information. I mean, that's pretty imperative, and across the board, it's we need your bank account information. If we don't have your bank account information, then this check, then the stimulus amount is going to get to you much, much slower. So, but the difference was that if you got a refund and gave them your bank account information, your direct deposit information, then you were sort of in that first batch, right? Got a refund, had direct deposit information, you were in the first batch. Because what has come out is that the IRS did not send the stimulus amount to folks that might have had bank account information on file with them, but at the end of the day, it was for an amount that's owed. It's almost like one of those things where if you owed them money, meaning if the money was going from you to them, they looked at that and said, okay, well, we can't use that information to send this stimulus payment to you. But if it was the other way, where they were sending money to you, then they felt comfortable in sending the stimulus payment. So that was a pretty big difference in terms of what the original expectation was on it. So if you owed money, even if you gave them your bank account information, if you owed money, then you've got to go through this next step. And that's pretty unfortunate and kind of crazy that, they kind of drew that distinction. I understand the reasons why. Maybe someone else was, taking care of the amount that you owed or something like that. But usually they also match up the names and the account numbers as well. So, but anyway, that is what it is. So if you owed money, even though you had your bank account information on your tax return, you're going to have to go to the irs.gov website, go to the click on my payment tab, and ultimately follow the steps to provide that bank account information. That is the only way in which you're going to be able to get that stimulus payment on a faster basis. So you've got to go through that process. The website to go to, again, irs.gov, that's the one that you go to. Find the Get My Payment, click on that, and then go through the process. And unfortunately, you're going to have to do that even if the IRS has your bank account information on file. It is immaterial if you wound up paying them or owing them. If it went the other way, where you got a refund, then you should have been in that category that got your stimulus check. But unfortunately for those that owed, then they've got to go through this next step of the process. So unfortunate on that, but at the end of the day, it is a process that we want to encourage you to do that, because it does speed up the receipt of the payment. So anyway, what else was going on this week? We talked about our investment conference call that we had for our clients here at Nelson Financial Planning. We gave you some of the thoughts that the portfolio managers were having in light of the current COVID economic situation. The other thing that happened that was pretty dramatic this past week was this negative oil price thing, right? I mean, what's up with that? Does that mean I get to go to Wawa and they pay me money to pump gas in my car? Probably not, by the way, on that, especially considering the refinery cost. But the reality is, though, that the price of oil fell to as low as negative $37.63 on Monday. How on earth does that happen? Well, first of all, you have to sort of understand the oil market, right? And like anything, the oil market is based upon supply and demand. And we've gone from a daily consumption of around 100 million barrels a day to the expectation is by the time the calendar rolls to May that it may be as low as 50 million barrels a day. the very definition of supply and demand, fundamental economics, right? If I have much less demand and I'm not able to reduce the supply, because that's the whole conversation that's been going on between Russia and Saudi Arabia and OPEC, they don't really want to reduce the output because they still want to be able to sell it. I think they also would like to see our shale production come offline, because shale production requires a higher price of oil per barrel to break even than just pumping it out of the ground, which is what they do over in Russia and Saudi Arabia. So from that perspective, you still have a high level of supply, and granted it's come down by 10%, but you're talking about a drop in demand that's almost 50%. So fundamental supply and demand, economics 101 would say the price is going to drop pretty dramatically, right? And not only is the price going to drop, but if you're sitting on a bunch of oil and no one's buying it, what do you have to do? You have to store it. And the storage costs is the I guess the reasoning why the price went negative, because if I'm going to take a barrel of oil, well, then I'm going to have to pay somebody money to store it. And so consequently, that drives the price into that negative territory. Oil producers these days are literally renting tankers. The national storage facility in Cushing, Oklahoma is projected to run out of space in May, and that further increases the cost of storage. So that's why the price drove as much as it did. But there's another factor in there as well, and that is the reality of the oil markets themselves. And there really is sort of two separate markets, typically closely related, sometimes not, that exist within the oil markets. There's the physical market, which is the actual delivery of the barrel of oil. I'm going to show up and give you a barrel of oil. You're going to pay me for it, of course. And then there's the futures, which is basically a contract to take delivery at a certain price. And futures contracts are used in a lot of industries, airline industries and the like, in order to sort of hedge the risk of what might happen with the price of oil anyway. If oil is sort of a volatile, has a lot of volatility as a commodity, so you use a futures contract to help hedge that risk. So a lot of airlines and other large consumers of oil will use a futures contract. Well, but a futures contract is a contract that take delivery at a certain price at a future date. So what happened on Monday is you had kind of this technical convergence where the May futures contract, the futures contract for May, was due to expire on the next day, Tuesday. So folks had to unload those contracts because very heavily on Monday, because otherwise the next day they'd have to take delivery of oil. So you wound up having a massive sell-off in the futures market, and then that correspondingly pushed down the price of oil pretty dramatically. Obviously, demand lowers the price of oil. The price of oil is going to continue to be low because demand's going to continue to be low, but it's not going to get to the point where they're going to pay you to pump gas. So certainly a very, very odd phenomenon that we saw occur on Monday. A lot of it has to do, as we said, with kind of how the oil markets work and this notion of futures contracts versus actually taking delivery. Having to take delivery today of a barrel of oil means that you may very well have to pay then for the cost of storing it, and that can start to be expensive. So that's what's going on with the oil markets. We're going to take a break. During the break, we'll come back and we want to talk about some retirement planning concepts with you, particularly for couples that have a significant difference in age. So we'll do that when we come back here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio, WFLA, Orlando. Welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio WFLA Orlando. My name is Joel Garris of Nelson Financial Planning, and you also happen to be listening to not just Central Florida's longest running radio program, but also one of the top 25 financial planning podcasts on the World Wide Web. So if you'd like to check out our podcast, you can certainly do that by subscribing to us on YouTube, where we actually do a video of the program. So you can certainly go to our YouTube channel at Nelson Financial Planning and subscribe to us on that. Or you can simply follow us on Facebook as well. Again, Nelson Financial Planning there. And then, of course, if you're looking to find us on things like iTunes or Google Play or any of those types of, or iHeartRadio, they like it when I plug the iHeartRadio here on the iHeartRadio network, then you can go to our website, nelsonfinancialplanning.com, and you'll see in the upper right-hand corner a bunch of different icons. Click on the one that looks most familiar to you, and you will be able to find us on that particular format. So this segment of the program, we thought we would talk a little bit about some retirement planning issues. And as we all know, retirement planning is complicated in and of itself. What it can exacerbate that is if there is a big age gap between spouses, right? If there's an age gap of, say, more than 10 years between spouses, that can really bring to light a lot of the difficulties in retirement planning itself. I mean, 10 years is a pretty good age gap, and that brings wide variations in things like retirement dates, in things like life expectancy, and things like healthcare. So some important considerations to keep in mind here. And the reality is that this age gap issue when it comes to retirement planning exists in more marriages than perhaps people realize. It's actually about 1 in 10 marriages that have an age gap of more than 10 years. That age gap expands even more so if it's a second marriage. About 1 in 5 men on a second marriage will have an age gap of more than 10 years with their spouse versus about 1 in 20 on the first marriage. So not going to get into the societal commentary on that, but the numbers are what they are. So, what are some of the common problems that you're going to run into? And some of these common problems exist just in general between spouses that don't have an age gap. So I think there's a lot of stuff that we're going to talk about in this segment and the next that actually applies to most married couples in terms of retirement planning, or just couples that aren't married, partners, if you will. The first, of course, is the notion of being able to agree on a retirement date. And that certainly exacerbates itself when there is an age gap, but that can sometimes be an issue between couples that are closer in age as well. And I think, as with anything, when you want to start to put a plan together, it's important to have the conversation. So make sure you're having the conversation with your spouse as to, okay, well, what date were you thinking? And here's the date that I was thinking. And then that can get exacerbated a little bit more when there is a big age gap. So the older spouse, right, may be more ready to retirement, but at the end of the day, it may be best to sort of stagger those retirement dates, particularly if there's an age gap, because you still have this issue with health insurance. I mean, the notion of staggering retirement dates may make some sense in order for the younger spouse to be able to continue to provide the health insurance, combined with the fact that if there's a continuing stream of income coming in, then it helps to delay when you would actually have to use your portfolio, right? So if both of you retire, one of them is 10 years younger, then that money has to last for a much longer period of time, right? So if somebody is 65 and they want to retire, but their spouse is 55, well, then that means that there's a much longer period of time that money has to cover in retirement. So again, that kind of complicates things. So the notion of a staggered retirement date, particularly when there's a big age gap, certainly makes some sense, particularly from the notion of the health insurance perspective, but also from the notion of having at least some level of income coming in, so you don't have to use the assets as much as you might otherwise if there wasn't that additional income in. Again, because of the age gap, you could have a much longer period of time where you've got to address this in retirement. Similarly, the issue then becomes, what do you do about Social Security, right? Because the survivor benefits are what that person who remains after and we'll play the odds, generally the older person, right, would pass away before the younger person. Not all the time, of course, but more often than not, that's the general trend, right? So if the older person passes, then you've got to really consider what that survivor benefit looks like for Social Security, because when that person passes away, then the survivor gets the survivor benefit under Social Security. So the older person needs to be careful about collecting Social Security too early, because obviously it's subject to a reduction, and then if they pass, then the remaining spouse winds up getting a lower amount. That gets particularly exacerbated, obviously, when there is a bigger age gap between the two. So a pretty complicated issue. One of our longtime team members at the office, Rob, and you've certainly heard us chat about Rob before, he is certified as a National Social Security Advisor. And so those are the kinds of more complicated, more intricate issues that we will tackle at the office. And obviously in that case, if it's a Social Security issue, that's sort of Rob's expertise, particularly with his designation as a National Social Security Advisor. So again, those are some pretty unique issues that you really need to be focusing on in terms of Social Security, not just agreeing on the retirement date and what that looks like, but then also Social Security and what that strategy might look like. Because certainly the issues involving retirement planning, as we're seeing just in these first couple of points, really start to get much more complicated. And they're complicated anyway, but they get much more complicated when there is an age gap between the two couples, the two people in the couple. So the next thing to really kind of consider is really sort of the drawdown strategy and what that drawdown strategy looks like, and where you get money at different points and in time, because obviously you're looking at with a 10-year age gap, you could potentially be looking at a combined retirement of 40 years, and you may very well need more initially, or need more at different stages in life. And so then it opens up the question of which to draw down first, and what that looks like. And certainly that's a pretty intensive conversation, and certainly we want to get some of the concepts for that out there. But we're going to actually hold that through the break so that we can spend some time on it to really delve into that a little bit more in terms of the drawdown strategy, because there's asset allocation issues to tackle on that, and there's certainly some tax issues to tackle on that as well. So stay tuned through the break. We'll come back and we'll continue this conversation of retirement planning. Not really, a lot of this is for everybody, but specifically for when there is an age gap between couples. So stay tuned for that when we return here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning News Radio, WFLA, Orlando. Welcome back, ladies and gentlemen, to the program. This is Dollars and Cents with your host, Joel Garris of Nelson Financial Planning. This segment of the program, we're talking a little bit about some of the retirement planning complications, not just for couples, but also for particularly couples that have an age gap of, say, 10 years or more. There's certainly some things that you need to be aware of. And this part of the discussion, we were actually focusing on some drawdown strategies, which I think are important no matter the age gap, but they get exacerbated if there is an age gap. And when you talk about drawdown strategies, you've really got to think of it in two different lights. First of all, you have to think of it in terms of the overall investment allocation, and then you have to think of it in terms of the ultimately the tax implications, right? Because the tax implications, if you're not managing those, you can have a tax bill that rapidly increases, and so consequently that is a big difference in terms of how much money you get to actually spend in retirement. If you're paying extra taxes and you didn't really have to, then that means you didn't have as much money for fun. And after all, that's what your retirement should be all about. So from a strategy perspective, you really got to take and divide out the assets that you have that either are not going to have any taxes on them, like say a Roth, or assets that are not taxed that much, which would be after-tax assets that would have more of a capital gain. Capital gains rates top out at 15% for the vast majority of people, and so that capital gain tax only applies to the profit that is in your that type of an account. So obviously that's a tax efficient way to do it versus retirement accounts where when you draw the money out, all of it is going to be taxable. So understanding the types of accounts that you have and the tax nature of them is sort of the first step on trying to figure out your drawdown strategy. Similarly, looking at the types of allocations that you have, right? So if it's a bucket, if you will, and this is the kind of the way we describe it at the office, is we kind of look at it and start grouping out those different types of assets based upon the tax nature. Those types of buckets, the bucket that you're going to draw down first, you would want to have potentially a more conservative allocation in there, because that's money you're going to use in the near term versus perhaps some accounts that you're going to use later on. Those could have the flexibility to be able to grow. And so the nature of the asset allocation also changes sort of based upon the tax nature and the utilization of it. So it's important that the drawdown strategy not just look at the tax implications, but also look at how those buckets of different money that you have are in fact invested. And where this gets a little bit more complicated now is with the stretch IRA, because the stretch IRA at the beginning of this year with the Secures Act was effectively eliminated in terms of the ability of a beneficiary to take that money out over their extended lifetime, right? Under the stretch IRA rules, if I inherit an IRA, I can then take out a little bit at a time each and every year for the rest of my life. Obviously, that was pretty powerful. It led to a lot of compounding in retirement accounts, but the folks in Washington said, wait a minute, we want to make sure that we get this money a little bit faster. So they shortened that window to just 10 years. So definitely a very different planning concept when it comes to inheriting retirement accounts. The exception still exists, though, that if you are the spouse, then you can treat that account as your own and you don't have to worry about the elimination of the stretch IRA. So that's very good. Now, what if I'm not the spouse, but what if I've been the partner for a long period of time? Well, there is still an exception that applies if you are less than 10 years of an age difference between your partners. So if you're the beneficiary and you're named the beneficiary and you may not technically be the spouse, meaning you haven't gone through and gotten the marriage certificate and all that kind of stuff, then you still would be able to take advantage of the stretch concept. If your age is more than 10 years difference, then you would not be able to take advantage of that concept. So a very important distinction there in terms of how that would work out, particularly with couples that have a bigger age gap. Certainly this concept of using retirement accounts and using those in such a manner as to perhaps you're using those a little bit more in order to avoid having to take out that money within a shorter period of time. So certainly some interesting things in terms of how the distribution strategy works out, particularly in light of sort of the new stretch IRA rules and sort of how that works out. Again, stretch IRA certainly applies if it's a spouse, no question at all on that. If it's not a spouse, but if it's somebody within 10 years, then you can still get the stretch IRA. If it's more than 10 years, then you don't. Then they have to take out over a 10-year period of time. And so consequently, then that really does sort of adjust what the distribution schedule might look like on that. And of course, that dovetails right into, the risk of outliving money, right? I mean, required minimum distributions are less when you have a spouse that is less than 10 years. There's actually a separate table for calculating out the required minimum distribution that is different, that uses a different factor than what you would typically have on your traditional required minimum distribution schedule. If your spouse is more than 10 years older, then that's a totally joint life expectancy schedule that calculates out your required minimum distribution. So your required minimum distribution is lower than it would otherwise be when you have that age gap. And now, of course, you have the opportunity under the Secure Act to invest in or put money into an IRA or a Roth at any age. Again, you've got to be working in order to be able to do that, but you've definitely got some options some positive options that have sort of opened up in terms of the ability to still continue to fund retirement accounts regardless of your age. Still have to be working, but you could be doing a spousal IRA. So if the younger spouse is still working, then the older spouse could still contribute to an IRA as part of a spousal IRA. So there's definitely some interesting options that exist given a lot of the legislative changes that happened under the Secures Act and how that impacts retirement planning, particularly couples that are more than 10 years apart. And then, of course, lest we forget, the biggest cost that many face in retirement is healthcare costs. And if you are the younger spouse, you really shouldn't underestimate the value of sticking with your job, particularly if it provides health insurance, because that is a big cost of retirement, and certainly having that cost covered by an employer certainly gives you a bit more options in terms of how to cover that cost. Because obviously the cost of health insurance, the cost of health care is a big factor. And if there's a big age gap in a couple, then you know that you have to worry about that for a much longer period of time, combined with the fact that the older spouse may need to utilize that health care more at an early stage, or particularly an earlier stage than what the younger spouse would have to. So it's definitely some interesting considerations to put in the mix, particularly when there's an age gap between couples. But a lot of what we've just talked about also applies just to couples in general, right? You got to make sure you're on the same page in terms of retirement planning. You got to make sure your drawdown strategy is as tax efficient and from an investment perspective allocated as properly as it should be. And certainly some important considerations. So anyway, we will wrap it on up and get on out of here. Thank you all for listening into the program. That'll do it for this week. But of course, we'll be back next week with the latest on everything that is going on out there in the world at large. So we'll look forward to having you join us next week on the program. This has been Dollars and Cents with your host, Joel Garris of Nelson Financial Planning, News Radio, WFLA, Orlando.